the classical sampling handout, we make it most way through that. There is one thing I want to talk about really quickly. The only reason I'm bringing it up is that I noticed in some of the exams that it came up that not everybody, but some people were the question about why would someone need an audit report. The audit report itself doesn't have any data in it. It has an opinion. So there is no data in the actual report. There is no, some people said they want to verify cash or whatever. Actually, there aren't any numbers in there. The only thing that it does do is it says whether the financial statements are fairly presented. As far as the data is concerned, whatever they do with the data that's in those financial statements, however they make make heads or tails out of them, whether it's a bank or investor or whoever, that's up to them. But we never verify. So for instance, somebody's ability to pay off a loan or anything like that. And to even go further, we can't. We cannot be an advocate for the client. And then I know it sounds strange, but we are not responsible for them to manage their inventory. We're not responsible for them to get loans. We cannot be responsible for those things, or else we would not be independent. And the whole purpose of what we do is that we're independent. So that audit report is really just to let whoever is looking at the financial statements know these are not materially misstated, or they're they're fairly presented, is another way of saying it. But we actually don't give any verification as far as this is a good investment, this is a good client, none of that. And we can't do that, or else we would not be independent. So anyway, I just thought I'd make that. I would say I didn't make it clear enough. But let's go to the chapter 3 handout. And this whole chapter 3 handout, I mean, it's all about. It says ethics, but it's a huge part of it is about independence. Here we go, employment. What is this, page 5? And it sounds like, I don't know, a little bit wacky, but they take it very, it's 20% of the auditing CPA exam. So it's a very serious, thing. Okay. Any questions there? Okay, the next thing we're going to cover are the employment interests. So up here we had the financial interests. These are all financial interests, investing in the company. But you can also have a conflict of interest if you're for the employer, if you're switching from one employee to another, or employer to another, or if someone in your family is employed, say with one of the firms. Okay. Let me go, let me switch cameras here. Dougie. Let's go to the Dougie cam. All right. So here's kind of the different scenarios that we can have for employment. All right. The first one we're going to talk about is if an employee from the client if they walk across and they go work for the CPA, look how happy they are. So this is an employee with a client goes to work for the CPA firm. What problems can you have for that? Now, this is fairly rare. It just doesn't happen that often. It could happen, but it's fairly rare that you have someone coming from the client and working for the CPA firm. One that's much more common is the other way around. And that is when you have people going from the CPA firm into the client. And they're happy too. And this is, again, much more common, so you're going to see a lot more of these. So going from the client, so let's say this is IBM. So it's possible you could go from IBM to work at the CPA firm. Much more common is going from the CPA firm to work for the client, or to work, if this was the auditor for IBM, they'll go work for IBM. So this is much more common to have happen, and there's rules go for both of them. Okay, share my screen here. Okay, my client's employee gets hired by the CPA firm. Okay. Okay, so the employee hired by the CPA firm cannot audit their own work for their former employer. So whatever work they did, they cannot be in an audit that audits that work. Okay, Gracie worked for IBM in the accounting department and was recently laid off from her position. She took a job with IBM's auditors. Can Gracie participate in the IBM audit? What do you think?
No.
No. Nope. Yep, you're right. You're both right. Nope. Yes, no, she can't work because she'd be auditing her own work. Now, if years go by and her work is no longer included in the financial statements, then she can. So yeah, so they can't audit their own work. So that one's kind of easy. Now for the very wacky ones. All right, so now we're into this situation here. And it makes a difference whether this is an issuer, the client. Now IBM is an issuer, but if it is an issuer or a non-issuer. So there's actually going to be two sets of rules here. I'm going to put this as number one and this is number two because that's why I give them on the handout. But it makes a difference whether the client is an issuer or a non-issuer. And I'll explain why in a second. But so this is very common. It's very common because I think I mentioned you in a CPA firm, it's up or out. If you're a associate and they don't think they can make you into a senior auditor, you're out. But they try to get you a job with a client. And what they want to really do is kind of stack the deck in their favor. They know that if they send you to IBM at some point in your career, you move up in IBM, and it comes to who do we have for our auditors? Well, hey, it's the same auditor. So, you kind of get that loyalty and so forth. They try to get their people working their CPA firm into their clients, and generally it's a pretty easy transition. Usually, it's very common. Something like 1 in 100 people that go into auditing become partners. So what happens to the other 99? Well, a lot of those go work for the client. So it's a very common practice. Now, so it's like I say, this kind of up and out thing, which sounds very cold. Actually, and a lot of times you go work for the client. They love having people come from CPA firms. CPA firms generally have a really good reputation as being great workers. You go there, you generally get better pay, better hours, and all that kind of stuff. So people, a lot of times, even though maybe it sounds bad, but it really helps their career to go into the client. So it's a very common thing that happens. Okay, so back to here. So if it is a non-issuer, a CPA firm employee in the M in there. They must be taken off the audit if they have accepted the job offer. So if someone offers them a job, they have accepted it. Or B, they are still considering the job offer. So they must be taken off the audit if they, one, have accepted the job offer from the client. I should say the client. Or B, they are still considering the offer. Okay, so they get a job offer. If they take the job offer, they got to get off the audit. So if they're auditing whoever they're auditing, if they accept the job offer, they get to take off that audit. If they're still considering it, they haven't said yes, they haven't said no. They still have to be taken off the audit. They can't be working on the audit. Now, if they've rejected it, they get someone given the offer, they said, no, I don't want it. That's different. Then they can stay on the audit because the job offer is dead. So as long as they are have accepted it or are considering it, they must be taken off the audit. They can't work on an audit for a future, employer. Okay, now the client is an issuer. Okay, first things first, same rules as above. He must be taken off the audit. But there is another, oops. If the position with the client is a key financial position, the auditor must, must be off the audit for an entire audit cycle. Talk about that in a second. Okay, so let's see. Oops. Let me clean this up for a second. Okay, so if the position with the client is a key financial position. Key financial position is somebody that can has influence over the financial statements. Then the auditor must be off the audit for an entire audit cycle. Okay, now this is big. No, not that. Hold on. It looks like this. So a complete audit cycle. It can be almost 2 years depending on when it's but my camera is. All right, it's sort of like this. So let's say that this is 2023, 2024, and this is 2025. Okay, these are the audit cycles. The entire year. So if you get an offer on, say, February 1st, 2023 for a key position, it has to be a key position. Okay, you can't do it for this audit cycle because you weren't offered for the complete one. You were working on it for a month. But so this, I was like, you have to do a complete audit cycle. So that would be, you have to complete here. So this means if they offered it to you on February 1st, 2023, you could take it on January 1st, 2025. So it's at least a year. Now, if they offered it to you in December, then it's, 1 year. But they say it has to be at least a complete audit cycle that you have to be offered. Pen. Sorry about the wacky color. So that's kind of a big thing. Now, in case by the way, this is one of those things that I always thought was going to get thrown out in court because it limits somebody's ability to make a living, and there's a lot of law based on, you can't keep me from making a living, and this is one of those things. But it hasn't been thrown out. One of the things that the Securities Exchange Commission did that was, kind of brilliant in this is that they didn't put the onus on the CPA firms, because someone in a CPA firm could say, "Hey, I want this job, and I should be able to get it because I'm qualified and blah blah." What they did is they said that the management of the company, so the issuers, the people that they have control over, they said, look, you cannot hire anybody in a key financial position that was has not been offered your audit for a complete audit cycle. So they put the actual pressures on the clients. It's on the publicly traded companies. IBM. If somebody's been on you can't put them in a key position unless they've been off the audit. Now, you may wonder why are they doing that? And why do they care? Well, here's why they care. The people that get in those key positions usually come out of either being managers or sometimes even partners to get into a key position. Those are big jobs, big salaries, and all that kind of stuff. So it's very likely that the auditors that come in to do the audit would have been the subordinates of those people. If I'm the manager for at the CPA firm and I am running the IBM audit, if I go working as a controller or a chief financial officer or whatever for IBM, those same people that I did their reviews, for them, that I may even be, they may even ask me for references and so forth in the future, they're going to be sitting across from me. You know, that's why they want it to be off for an entire year, so that any of those auditors that are still around will not have been underneath that person, whoever it is, for that, at least an entire audit cycle. Because, you know, you don't want to have someone facing off against somebody that, you know, may have been their mentor and who they may rely on in the future for things like references and all that kind of stuff. So that's kind of the idea behind it, to kind of break that cycle of blurring the lines, basically, of loyalties in the CPA firm. Okay, so let's see how this works out. Issuer. Sam is a member of the IBM engagement team. He's offered a job at IBM. Sam has not accepted or rejected the offer. Can he still work on the IBM audit?
No.
Nope. If he's rejected it, then he can, but other than that. Nope. George is a member of the IBM engagement team. He recently got a job offer from IBM. The job is for staff accountant. Can George immediately accept the offer?
No.
Staff accountant, probably yes. You can probably do a staff accountant. That's probably not going to be somebody. Well, you know, while they will do accounting work, they're probably not going to have a whole lot to say with as far as the financial statements go. So I would say a staff accountant, probably yes. Now it does depend on the size of the company and, you know, the responsibilities. But if it's just a regular staff accountant, someone's just going to make journal entries. Okay, now 14 is a little bit more. Right, Lisa, IBM, and she got the job is for a controller position. So controller is kind of like the top accounting person in the company. Oh, it's not. Hold on, let me try this. Let me try that again. So controller is usually the top accountant person.
No.
No.
That's obviously going to be a key financial position, so they must be offered an entire audit cycle, which may be up to almost 2 years, depending on when the offer was given. Okay, now 15, non-issuer. Mickey is a member of the GeoCorp audit engagement team. GeoCorp is a privately held company. Okay, non-issuer. She recently got a job offer from GeoCorp as the chief financial officer. Can Mickey immediately accept a job offer?
Yes.
Yep, very good. Yeah, if it's not publicly traded, you know, she'd have to be taken off the audit, obviously. But if it's not publicly traded, you can walk right into a key position. Now, truthfully, though, if you think about it, you know, a lot of times companies that aren't publicly traded are smaller companies. And if you're working as an auditor or kind of a CPA firm, it's very likely in a smaller company, when you walk in there, you are going to get a higher position. You know, but they may only have 5 people in the accounting area. So when you come from a CPA firm, you may very well be the controller or chief financial officer or whatever it is. So that's it. Part of that is that it's, you know, the size. You know, it's really different to be, you know, chief financial officer of a company that has 180 people than it is a company that has 180,000 people. So, you know, there is a, you know, that kind of a level thing that you probably will go in at a higher position if you go into a smaller company. Okay. Employment interests of family members and close relatives. So this is your could be your immediate family, it could be you know, your close relatives and all that, but basically, family members and cultural others cannot occupy, our favorite term, key financial position. Boy, did I mess that one up? Hold on. Let me clean that up a little bit. Oops. All kinds of problems here. So they cannot occupy key financial positions of it. And by the way, it's a little bit, actually, the financial positions part is a little bit new. It used to be key positions. And now they've kind of loosened it a little bit. They said, okay, it can't be key financial positions. So if it's not a financial position, they generally can take it. If it is a financial position, in other words, that they're likely to have influence over the financial statements, then it's a problem. Okay. Sam's a member of the UP1 Audit Engagement Team. Sam's mother is the Chief Financial Officer of, I guess it's up one. Is Sam in violation of the independence rules?
Yes.
Mary is a member of the UP2 team. Mary's father is director of design at UP2. Is Mary in violation?
No.
Nope. Probably not a financial position. I mean, if it was, then yeah, but it probably isn't design. So even though they're both directors, because one is a financial person, it's a no-no. And by the way, this is another one of those things that is a little bit controversial because somebody could be prohibited from doing an audit because of, a family member. And obviously, if someone's a chief financial officer, they're not going to quit their job. But also, you got to realize too, though, that almost, there's only a handful of jobs that are going to be key financial positions in most places. So somebody coming in, even if someone was a manager of this, operating manager that has 800 people working underneath them, if they don't have anything to do with finance, it's not a key financial position. And again, that's kind of a new one because it used to be key position, now it's key financial position. Okay, now independence for non-covered members. So this, I'm going to go back up to the top here. So non-covered members, the question comes up, well, what about these people? There's no rules for these people? They can do whatever they want? And the answer is there are some rules. They're much more lenient, but these other people that are not part of the covered members, they also have rules. So if you're not a covered member, doesn't mean that you can do whatever you want. There are some limitations. Financial interests. Non-covered members cannot own more than 5% of a client. But I should say CPA firm. If so, oops. The entire CPA firm is not independent. Okay. So financial interest. You can't own more than 5% of a client of the CPA firm. And the whole CPA firm is not independent if there is somebody that owns 5% or more. Or more, I think it's more than 5%. Now, for publicly traded companies, this probably isn't. I can't imagine it coming into play. If you own 5% of IBM, you're probably living on an island somewhere. But for smaller companies, for smaller clients, that may not be that unusual. You may have somebody who went to, who their family owns grocery stores. Maybe they own, 6, 7 grocery stores. Maybe they, one of the kids goes to college and becomes an accountant. And works for a CPA firm, and maybe the stores need their auditor. They go work for the auditor. Maybe they own 10% of it. So, well, publicly traded companies is probably not that, is fairly unlikely, but for non-publicly traded companies, it could certainly come about. Okay. Question on anything? Employment interest. Can I be a member of the client's upper management? Or on the board of directors? There is a there's an exception to that I'll talk about. So they can't be upper management and they can't be a director. Okay, James is senior auditor for a CPA firm that audits IBM. However, James is not a covered member. James is also an ordained minister and recently accepted a position on IBM's board of directors as a spiritual director. James is not on the audit committee at IBM. Will James' position impact the CPA firm's independence? Anyone?
No.
Actually, it will. James they cannot take that. You can't have anyone on the directors who is a non-covered member. And even if they were on the board of directors for one day, that makes the entire CPA firm ineligible. Okay. Question on that? And by the way, there are, however, this is to kind of monkey up the water a little bit. If it's not a publicly traded company, and the board of directors position is purely honorary, which does happen sometimes. Sometimes they'll have for instance, like a community college. They have auditors come in, they do audit, but they also send out brochures and stuff. And one of the things they may want is, hey, we'd like to have you, listed on our board of directors. Now, you're not going to make any decisions. You're not going to do it. You're going to show up twice a year and you're not going to get paid anything. You show up twice a year and you have some coffee and donuts and then, wave at people and they take pictures and that's it. If it's purely an honorary position, in other words, you have no direct authority as a man, as a true working member of the board of directors, In some cases, that's allowed, as long as it's, like I say, it's, as long as there is no, generally no payment that would be, considered material. And it's like $10 or something, but generally it is not, and usually these things are honorary, and it's not that uncommon. That, as a CPA, you're kind of looked at a little bit differently than a lot of people. They kind of looked as an upstanding citizen. So they kind of like to have you around just to, show people, hey, this is Cindy, and she does her audits, and but even though you don't actually do any of the board of directors work. Okay. Stuff's dry. Sorry about that. Boy. All right. Past due professional fees. Unpaid audit fees because independence issues. The lender. So unpaid audit fees. So you did an audit, they haven't paid it yet, and you're back, or they haven't paid some of the fees, whatever it is. Unpaid audit fees, notice that now you have a financial interest in the client. Because you want the client to be successful so that you can get your audit fees paid. So unpaid audit fees are an independence issue, and you cannot do an audit if there's unpaid, because now you are an investor, you're a lender in the client. So they have to pay the audit fees before you can work on their audit. It sounds strange, but that's that's actually a kind of a big one. Gifts. There's only 2 rules to gifts. They should be clearly immaterial. Or oops. This is kind of a US rule, appropriate in the given circumstance. I call this the golf rule. And they generally don't do this internationally. Golfing is kind of a strange, mostly US and some Asian business endeavor. So clearly immaterial. So if they give you something that, whatever, the holidays, they give you some cookies or something, fine. That's not going to sway an audit. You're not going to throw an audit for a box of cookies. However, the second one, appropriate given the circumstance, and I really do think that part of that is that for the golfing, and that is some of these, a lot of these CPA firms and their clients are members of these golf clubs, and the green fees are crazy. I mean, they can be in the thousands of dollars. Clearly, they would be material, except for this rule that in the circumstance of golfing, that they're appropriate, and that is one of the weird things about the U.S. business and so forth. By the way, if you become a partner in a CPA firm, you're going to have, I would say, at least 1 golf club membership, and probably 2. It's just the way it is. So these golfing, and it's kind of a US thing. You know, a lot of times in Europe, it's not that big a deal. Golf is a bit crazy, but yeah, so it either has to be clearly immaterial or appropriate in the given circumstance. So you may be invited onto the company golf. I mean, even though it's $3,000 fees, it's appropriate in a given circumstance. I'm not saying I agree with it, but that's kind of the rule. All right, litigation. And this can come in two forms. Litigation between the auditors and the client may impair independence. Oops. Okay, also. Litigation between clients. So for example, let's say that you're auditing IBM. Maybe you have Microsoft and IBM for clients. Pretty good clients, but it's I'd almost bet that they have some kind of lawsuits going between those two. But so litigation between your clients may impair your independence. Remember, you have access to a lot of basically internal information for both of these, for both of your clients. And there may be a problem with you knowing a lot of information that, back and forth. And remember, you have a fiduciary duty. And if you have both of those clients, you have a fiduciary duty to both of them. So you can run into this problem of, seeing confidential information for both sides of a lawsuit. So it's possible that if you have a lawsuit that, that is material to the audits and all that kind of stuff, that you may have to drop one of the clients. I am going to cover this later. Every time I look at this handout, I think I'm taking this one out because I cover it more later on, but did we already do reporting illegal acts? Maybe we didn't. All right. Did we cover that in chapter 1? I seem to remember we did. Maybe I'm wrong. We talked about if it's I think we almost did. I'll cover it again. Reporting illegal acts. First of all, we only look at things that are material. But also illegal acts I think we talked about this. This is a materially illegal acts. Materially illegal acts must be reported to upper management and the board of directors. Client fails to act on the illegal acts appropriately. All right, if it's an issue, if it's a non-issuer. I think we talked about this. Non-issuer get a lawyer, which I know is a cop out, but that's what you do. And if it's an issuer. Attack the SEC. In 24 hours. I think we already talked about this. So illegal acts, you must report them to the board of directors and upper management. If the company fails to, if they fail to act upon it appropriately. Then you, if it's a non-issuer, get a lawyer. If it's an issuer, you contact the SEC within 24 hours, and you must do that. Or else they'll come looking for you. So 24 hours is the maximum amount of time. All right, we'll finish this up and then we'll take a break. Subpoenas. Okay, CPA firms have a fiduciary duty to protect their clients' confidential information. However, CPA firms are generally required CPA firms are generally required to honor valid court order proceedings. So they don't have to share information with basically anybody. But if there is a court ordered subpoena, then generally they do. And I say generally because there are a few states that don't require that. There are a few states that CPA firms basically have the same client privilege as lawyers do, which is kind of unusual, but in some states it's almost like that, and that they generally don't. They may not have to. I should say, is the way of putting it. They may not have to honor a court-ordered subpoena. Okay. The auditors uncover evidence that their publicly traded client is, let's say, publicly traded. Oops. Routinely violating environmental. When presented with the evidence, the client's order management and board of directors do nothing. No, do not respond within 24 hours. In this scenario, the client should do which of the following? This is wrong. What's wrong with this? You should say client. Change this to auditors. In this scenario, the auditor should do what? I think we already did this one. Anyone?
B.
See. Well, it really depends if it's material or not. But if they're doing something wrong, if you present the evidence to the client and they don't respond, it depends if it's not independent, if it's not material. B. If it is, actually, let's put that there. If it's immaterial, that's not a great question. There's a few problems with it. I'll have to go back and take another look-see at that one. Get a little more information in a little bit. If it's material, then it would go to the SEC. Okay. The auditors uncovered evidence that the CEO of a publicly traded company routinely parks his car illegally in handicapped parking spaces. When presented with the evidence, the client's upper management did not respond within 24 hours. In this scenario, the client should do the following.
B.
Yeah, it's not material. Now, it's despicable, but it's not going to be material. All right, let's stop here. Like so much of the definition stuff, though. And let's go ahead and take a break. Let's see. Oops. And 6:54, so let's say 7:04. I think probably get these on the same page. take out the classical sampling handout. I think we're up to page 2. Or problem 2, I should say. Page 4. Okay, so basically, just to kind of reiterate what we're doing here. So basically, the client comes to us and they'll have something on their books like this, they have accounts payable, the book value is $5 million. And now we have to get evidence, and evidence either corroborates or refutes the client. So it either supports the client or it goes against the client. If it doesn't do either of those, it's not evidence. And so what we're basically doing is, doing this statistical sampling to corroborate what the client has there. They say that they have 5 million accounts receivable, and we want to see if that is a reasonable number, if it is, or if it's possibly misstated, and if it's misstated, is it materially misstated? So that's kind of the whole point about it. And I think I mentioned before, maybe I did, that people say, well, why don't we just, they have 1,000 accounts, accounts payable. They have 1,000 accounts payable. Why don't we just go through all of them? Well, because a couple of reasons. Statistically, a lot of times you can get to very high levels, 95%, 99% confidence levels, taking a much smaller sample. You might pick 100 items or whatever it would be, that you would get to 99% level. And that's, that's a pretty high standard for accuracy. Another thing, I don't know if I mentioned this before or not, but is that sometimes you cannot take 100% sample. If you were to audit, say, all the transactions for Walmart, or all the inventory for Walmart, it'd be impossible. Not enough auditors in the world to do it. So in some situations, you must take a sample. They also use the whole thing for medicine. If someone comes up with a new medicine, you can't round up all 8 billion people on the planet and have them take the medicine. You take a sample. Okay, here's a sample of people. Then we say, okay, I've worked with 42% of these people. So project it over the entire population and say that it'll help 42%, whatever it is. So there are times you cannot take 100%, especially for the larger companies. It's just not possible. So you must take samples. All right. So the audit firm needs to collect evidence to determine if the client's accounts payable is materially misstated. All right. So here's the items we took. Here's me messing it up like I usually do. And so we're going to get an average. Right. Okay, so to get an average, we're going to do what? Divide these by 10. Did something. Yeah. Okay. So the book value was 5,040, the average.
Professor, I think we worked on this one, unless I worked on my own, but I do have these numbers already. Oh, never mind. Maybe I did it on my own.
Did we? I can't remember, to be honest with you. I don't have it. What was I doing?
Never mind. I think I did it on my own.
Okay, well, that's good. I mean, I'm sorry, you want to go, well, walk the dog or something. All right, so, oh, I just did this wrong. Let's try that again. First one's the audit average. I'm very generous with the spacing here. I can't get that. Where can I get that to go? Oh. All right, well, anyway, this is 15140. Okay. And part of going through this is copy these. Actually, do something different here. Part of the reason for going through here is I kind of want you guys to get used to not looking up the formulas from, but just kind of thinking about what they're actually looking at. When it comes to the mean per unit, so mean per unit is really just the same thing as average, right? Mean is the same thing as average. So mean per unit is the same thing as average per unit. I don't know if I talked about this before or not. Which average is more persuasive, the audit average or the book average?
Audit.
Yep. The audit one is the one that's going to be the most important one. Because that's information that we've gotten ourselves, not that somebody's handed it to us. The book average is what they handed us. This is when we went and looked and see, okay, what's it really? So audit average. So when we talk about the average here, we're really talking about the audit average. Oops, I didn't mean to do that. Okay. So we're going to take the audit average, and then we can do it times per unit. And 4 times total number of units. Now, in this case, this is gonna be the number of accounts payable. 1,000. So what we're saying is, look, we came up with this average. And we think that every single item, everything in accounts payable should be the same average. So this will be our projected value. Okay, you question on that thing? By the way, one of the things that's kind of funny about, back in the day when I took the CPA exam is we weren't allowed to use calculators. So a lot of times you have these really kind of easy, equations like this. And it was actually kind of good because you knew if you came up with some weird number like 5.378, you knew it was wrong because they always came out to these nice, round numbers. Okay, so the accounts payable of the book value is 5 million. Projected value based on our sample.
Let's go.
Huh?
We're on nothing.
So our projected misstatement. Is what, 314? Overstatement or understatement? Are we saying their books are too high or too low?
Too low.
Yeah.
Understatement.
Very good. Yeah, so this would be an understatement. We're saying that their book should be 5,314,000. They only have 5 million. Now, the 314. There could be discussion whether that's material or not. The CPA exam does not actually have you make that determination. They don't go into the judgment part. But now everyone should get the same misstatement. And whether it's material or not, that's a judgment call. But the thing that's not a judgment call is if we're all using the same method, that we should get the same projected misstatement. Okay. That's the mean per unit. When I was doing auditing, I did use this one. I know I used it. I don't think I used it that much, but I'm almost positive I used it at least 2 or 3 times in the manufacturing stuff. A lot of times that stuff was around the same price. Okay, ratio estimation. Ratio estimation is ratio estimation basically says that the errors, the misstatements, will be in proportion to the size of the item. So a large item will have a larger, potential misstatement than a smaller item. You know, it's something, if you have a $500,000 account, being off by $2,000 is, you know, that's certainly in the realm of possibilities. It'll be a $2,000 error. If you have a $20 account, it'd be very rare to have a $2,000 error on a $20 account. It could happen, but it is probably fairly rare. So ratio estimation says big things, big misstatements, small things, small misstatements. Okay, and we do a ratio here. Audit to book. So we're going to take this ratio and then we're going to multiply it by the book value. And this will give us our projected misstatement. For Mr. Calculator. All right, 5,069,261. It's either 261 or 260. I don't know. My limited little calculator doesn't have enough what it needs. But did you guys get 61926?
Yep, that's what we have.
Yeah, okay, good. All right, so this is going to be our projected value. Yeah. Space. Okay, so this is gonna be our projected value. So the projected value, misstatement is 169. Is that an overstatement or understatement?
Under,
Yeah, we're saying it should be 5 million. They only have. Or excuse me, we're saying it's to be 5,159,000. They're saying it's 5 million, so we're saying you have it too low. And again, we can, argue about whether this is material or not, but the misstatement is 169. Again, this is giving us evidence about whether their books are misstated or not. The last one is probably the most missed one, and it's probably the one of the harder of those, and that is difference estimation. And it's difficult because we are getting the we get the projected misstatement first. The other ones we get the projected value first. This one we get the projected misstatement first. So we find the difference. Okay, now the difference is what, 160, 174? check that. And is this gonna be an overstatement or an understatement? We're saying that the average should be 5,314. They're saying the average is 5,140. So is this an overstatement or an understatement?
Under.
Under, good, yeah. They have it too low. Okay, so we're gonna say that each one of those is gonna be off by the same amount. So we're gonna multiply it. We're saying, okay, everyone's off by 174. You need to add 174 to each one of your accounts payables. So that would be a 174,000. Projected misstatement, and we've already said that this will be a statement. Now, here's the wacky part of the wacky part. We have to back into our projected value. So this is 174,000. And so the projected value, if this is understated, this would mean this would have to be what? What would the projected value be? Oh, you guys have it.
$5,001,074,000.
So this would be our projected value. I don't know that I've ever did one of these when I was doing auditing. I don't think I ever did a difference estimation. It could definitely come about. It's basically when it's kind of like the difference is between this and the ratio. Difference estimation says no matter what the size of the account, it's going to be off by the same amount. So in this case, $174. A $1 account's going to be off by 174. A $20,000 account's going to be off by 174. They're all going to be off by the same amount. Okay. I think I'm going to give you number 3 as homework. So do number 3 as homework if you haven't already. And we'll talk back in it. I'll give you a clue though on this one, and not a clue, but it's kind of a heads up, and that is the overstated and understated, they're not all the same. You know, the ones we've done so far, you know, all of these were understated. The first one, I think they're all overstated. Yeah, the first one we did, they were all overstated. Oops. But you're going to get a mixed bag of over and understatement for number 3. So if you're not doing it wrong if you come up with, you know, one being overstated, one being understated. It's just a method. Any question on that? So we'll do that as the homework. We'll come in next week and go over that. We should finish this up by next week. And we'll probably finish up chapter 3 next week too, and do the practice exam. Okay, so let's do that one as homework, and we'll do that first. Well, no, we'll do it the second thing in class. But yeah, see if you can figger out this one. And again, it's good. You're going to have a mixed bag on the over and understated. Also, I have the grades in for your exams. The extra credit points are not added in. Those will be added in shortly. Hopefully tonight I'll get them in. The extra credit points are not added in yet, so they're, you know, expect them to go up a little bit if you, you know, if you're wondering, hey, what happened to those extra credit points? I haven't forgotten about them. I just haven't got them in yet. All right, guys had enough of this tonight?
Yes.
Well, that is,
Absolutely, but thank you, Professor.
all right, well, we'll see you guys in a week's time and see if you can do that number 3 sampling one. All right, have a good evening.
Have a good night. Thank you.
Thank you, Professor.
See you.
Bye, everybody.